Hello everyone. Everyone knows property market has been very hot since beginning of this year. Lots of people are looking for the homes to live in, and we find lots of first home buyers on the market as well. Today we invite Richard to tell us something before we purchase a property. Recently, we see lots of first home buyers, they are looking for properties on the market. We also see lots of properties, they upgrade their first home, they buy the second home to live in. And in doing this, they find they need to, some people, they probably need to get money from the first property. They just refinance. And when they refinance the money out from first property to purchase the second property, they find there are something they never noticed before. It's regarding the interest rate. They pay. Sometimes they can't deduct, for tax purpose. So today we invite Richard to talk about this. What you need to know exactly before you buy the second property. Yeah. So Richard, can you talk something about this? Yeah.
Hi everyone. My name is Richard. I'm the co-founder of Sunplace Property Group. Like Junyi said, the market has been pretty strong since the end of last year. It has came very hot, and a lot of people has what we call fear of missing out. So people are jumping into the market in a rush, making that rush decisions. The reason for we're doing this video today is we want still to remind our first home buyers to make an informative decision before you make any purchase. And your loan structure is definitely one of the most important things when you purchase your home. Most of the Australian families, when we purchase our first home, we would need get a loan from the bank. Most people, we wouldn't consider the structure of the loan before we purchase. Actually, a lot of people, when they purchase their first home, they don't even have a roughly idea of what is the plan for this property. According to the data of ATO, most of the first home buyers, more than 90% in Australia, live in their first property for less than 5 years. But we met a lot of clients every week. A lot of people still thinking they'll live in the first property for a long time. And that might be true for a lot of people. But we often found out when the family circumstance changes, when maybe job situation changes, people will often need to change your home or upgrade your home within the first 5 years.
Yeah, that's true. Yeah, and also I remember when I bought my first home many years ago. I think it's about 12 or 13 years ago. When I bought the property, what I look at is I was looking for which bank offer the best interest rate. Yeah, so I think most of people is doing this. Yeah, we compare between each banks, and later on what I find is by comparing different banks, and it probably dropped my credit score because some other bank will think, oh, why you inquire, have this inquiry to the previous lenders. They would think maybe because you couldn't get the loan from their lender. They wouldn't think you just want to compare the interest rate. So this way, basically, it make the credit score a bit low, and it's hard to get a loan approved later on if you incur too many lenders. And also, on the other hand, when people compare the interest rate, normally people look for the best rate. So on the market, we know, for example, variable rate. If you go off-sale account, normally your interest rate is a little bit higher, maybe 0.1% or 0.2%. So lots of people maybe will go for the basic variable rate, which is slightly cheaper. But the issue is, if they go for this one, they can't get off-sale account. But many people, they don't understand why they need to have off-sale account. So Richard, are you able to talk about this? Why they need off-sale account? If interest rate is higher, why they need to do this?
Yeah. So first of all, I would just want to say we are not the finance expert. We are in the property industry. So we see a lot of clients through their whole journey buying their first home. So we want to give some basic share some basic knowledge, but this is not a financial advice. So I have a client that's like Junyi said, when she bought her first property, she wasn't in the position of making an informative decision. She's actually in a very good financial position. She has over 50% of the down payment available for her first home. It was roughly $450,000 for her first home, and so she paid over $200,000 to this property. And the idea was because she was just graduated from school, this is her first property, she didn't want too much pressure. She doesn't know whether she can afford to borrow that more than 50% of this property. So she was very conservative, and after a few years she got married and going to have a baby, and her and her partner want to upgrade the current townhouse to a bigger house. So, and they want to get the money out of this townhouse, so refinance some equity out. Like I said, she has roughly 50% of equity in this townhouse. But they don't want to sell this townhouse, they just want to refinance the money out. So to turn this property, let's call this home one, to turn home one into an investment property. And after they purchase the home, they refinance 30% of equity out and to use the 30% as a down payment to purchase the home. And of course, plus a bit of savings they've been saving for the last few years. They found out, originally they thought the interest of the home one can be tax deductible. This is the expense for this rental property. But because of the 30% of the money they drawn out, refinance out, the purpose of that money is to buy home two. It's their home to live in. So the purpose of this money is not for investment. And that's why ATO said this part of the interest is not deductible. It's not tax deductible. It can't be used as an expense towards your investment property. So they end up losing that sort of that deductible amount towards the rental property. A simple solution to the situation is, like Junyi mentioned, offset account. If she could have an offset account before she purchases this property or when she applying for the loan, she is not losing much interest. Like Junyi said, it's 0.1% a bit higher, but you have much more flexibility. When you have the extra cash in your hand, you put it towards your offset account. That'll offset the interest you'll be paying on the loan. For example,
Richard, are you able to draw something on the board so people can understand clearly how this works? So yeah, maybe it's better to do it on the board.
Okay. So this is home one. She purchased home one using 50% deposit and 50% loan from the bank. A few years later, like I said, her situation changes. She want to upgrade to a bigger home, which is we call home two. Refinance 30% of the money out, equity, because you can refinance the equity out of your first home if you have the borrowing capacity. So using the amount of refinance 30% plus their savings to pay the down payment for home two. And then after refinancing home one, become 20% in equity and 80% in loan. If this is a straightforward investment purchase, 80% of the loan, the interest of this loan, it is tax deductible. So it's part of your property expense. You use your rent to manage your expense. If it's a minus number, you can use that as a tax deductible number. So we won't go into details, but because the 30% of the money she got out of this property, the purpose of this money is to buy an owner-occupied home. The purpose is not for investment. The interest on this 30% of equity is not tax deductible anymore. So she ended up losing this benefit over a mistake she made for the structure setup. So a simple solution is, like we said, we can use the offset account. So with the exactly same case scenario, instead of getting 50% paid into your loan, you can still pay 20% and get 80% loan here, and put your extra money into the offset account. So you are not paying this 30% here to the offset account, and you are not paying for the interest of this bit of the loan because you have money sitting in the offset account. We understand offset account, the interest can be a little bit higher, like Junyi mentioned previously, be 0.1 or 0.2% higher. What you can also do is to apply for a combined mixed loan. Part of your loan is variable, have an offset account. Part of your loan can be fixed, and you enjoy that bit of low interest rate. Like I said, we won't go into further details of the finance advice, but if you need further information, feel free to contact us and we'll direct you to the finance expert to have your structure set up correctly.
Yeah, so after Richard explained this, yeah, we can understand even the money coming out from the investment property, but we still can't, deduct. This interest is not tax deductible because this amount of money is used for owner-occupied home. The purpose is for owner-occupied home. Even the money coming out from your investment property. So, lots of people, they don't know this. Yeah, even people have bought a few properties, they don't understand this as well. But if we don't know this, this amount of interest is not tax deductible. It could be thousands of dollars every year. And that's why it's so important when we buy the next home, or even when we buy the first home, we need to talk to the professional people like Richard. Basically, you get understanding, especially in future, if you want to buy your second home or third home. It's very, very important to have your structure right in the beginning. And people, if they go to talk to lender, some lender, if they don't have enough experience, if they don't have the big picture, they wouldn't explain this to you. And for myself as example, when I bought my first home, I asked a lender, should I have offset account? Because interest rate is slightly higher. If I got extra money, I can put the money in the home loan account. Why I need to put it in the offset account? The lender told me, yeah, you are right. Yeah, you can do that as well. But later on, when I buy the second home, when I find out the interest, from the for the money I took out from the first home for the second home purchase, the interest is not tax deductible, but it's too late. It's already too late to change. So that's why we want to pass all this experience, our knowledge to people, so you don't make the same mistakes. Yeah, and this is just one part. Interest, the loan structure is just one part of the property investment. There are lots of other things people need to know before they buy the property. That's why we strongly recommend people to talk to professional people before you do anything, because most of the case we don't know what we don't know, and you can only find what you don't know when you ask professional people. And we hope this video can share some valuable knowledge to everyone, and we thank you, Richard, to share this with everyone today.
Yeah. Thanks, Junyi.
Okay, we see you next time. Bye bye.
See you, everyone.
Bye bye.
Bye.